right, so I run through and talk to a lot of people over the years because I've done a lot of coaching, and people will call me in for a 20-minute chat. And what happens is sometimes they have a portfolio and they've got a good sized portfolio, let's say $1 million plus, and they're wondering, should I keep working the wheel strategy? Is it smart? Or here's what I'm doing. And now I've got some stocks that I'm picking. So I want to share with you some insight on some of these coaching calls that I get and give you some thoughts on if you have a larger account portfolio, maybe $750,000 or more, $1 million plus, that kind of thing. And how is it that, you should start looking at that portfolio and thinking about it? Because you might say, I already kind of know the wheel strategy. I'm kind of doing the put side, and I'm selling puts to acquire stocks, or I'm selling covered calls. What else should I be thinking about? So in this video, I'm going to share with you some insight. Now, if you're brand new here, I'm Sasha, the options coach. Ton of classes that I do and a lot of one-on-ones and coaching that I've done over the last decade. So here to give you some insight on this and just share with you some insight exactly from one of the sessions. So obviously, I won't go into the specifics of the person's name or anything like that. But here's what happens is that people out there with, let's say we're going to take a student name, Joey. Okay. And Joey over here has got a $1 million plus account. Okay. So we've got 1 million plus. Now, the thing with him is he goes in and he trades a bunch of couple of stocks here and there. But the problem with some people when they go in, especially with Joey here that we've had, is if you've got a $1 million account and he'll put it into maybe 2 tickers, so let's say about $500,000 a pop. We have a concentration of risk. And when you have a concentration of risk, you are betting on things, okay, all for one side, one direction, or even just 2 vehicles. And now you've got half of your life savings, you could say, in 2 different vehicles. And if the market tanks, now you've got an issue and problem. And when you start seeing these things, you start saying, well, that's okay. I mean, the market typically goes up. But the issue is what if that one stock or that one concentration spot goes against you? Well, then you might say, well, what about an ETF? Well, again, what if you have a 10-year down market? So again, you're going in and you have a concentration of risk to the bullish side. So one of the things that people tell me is, I believe in the stock. I really think this is a great company, and that's fine. But if somebody like Steve Jobs back in the day announces he has cancer, I mean, there's some things that you just can't avoid. It might be a great company, but it can still rattle a portfolio, and that can be very problematic. So my point here is that first things first, learn to spread your money and capital, spread it into different vehicles. Now, once you're in that stage and level, you might say, well, why does that matter to spread money? If the market goes down, they all go down. And technically, yes, that's true, but they all go down in different speeds. But here's the thing that most people aren't thinking about is once you start learning to spread money and capital, if instead of having 2 positions, if we look at a portfolio and now we take this portfolio and we actually start splitting it into more bite-sized pieces. Okay, so let's say we've got a little bit more pieces. And in this case, we've got, let's say 1, 2, 3, 4, 5, 6, 7, 8, 9 pieces. What we can actually start doing is taking 3 or 4 of these pieces, and maybe 3 or 4 of these are not bullish. They actually might be bearish positions, meaning instead of doing covered calls, we might go in and do something like covered puts. Now, this is known as the reverse wheel strategy. So you could say, okay, well, these 3 items right here are going to be my bearish mix. Okay. And that bearish mix is going to offset that portfolio. Now, it's a little different than going into doing the wheel strategy. We did the reverse wheel here not too long ago in the classes. And if you're interested in this class, just check it out down below or on our website at optionsblackbeltthere.com. You can also get, access to all of the classes that we've got. We've got a ton of classes. If you like, just book a call and we'll set you up there. But anyway, the point with this, with the reverse wheel strategy is you can do it in a bearish market condition. See, the standard wheel, what it does is you buy 100 shares, then you sell covered calls against it. Then eventually those calls expire worthless, or it's exercised, and then you sell puts to get the stock, and you keep going around this process. The reverse wheel is a little bit backwards. You sell 100 shares there at that beginning stages, okay? So you're actually negative shares. Then you sell puts to lose the shares, or really to acquire the shares, because you're negative 100 shares. or if the puts expire worthless and the stock keeps going up, then what happens is that, well, you go in and sell it again until the put goes in the money. I think I have a position maybe here. Let me take a peek if I have the reverse wheel. I don't have too many of them, but right here, here's Coca-Cola. Okay, so Coca-Cola will go into the reverse wheel because we did this class like a couple months ago. So I don't have a position on this one right here, but here's negative shares on the position. So let's say you have mostly the portfolio bullish, but this one or two or a couple of positions are negative. So if the stock goes down, you profit. If it goes up, you lose. But here's what we can do. We can actually take Coca-Cola and we can sell, let's say, a put against it to acquire those shares. And what it does is it looks very similar to a covered call position, but what you're doing is a covered call backwards. So it's kind of inverted, going to the other side. Anyways, it's a pretty interesting concept. And especially when you start thinking in terms of portfolio, this is where a lot of people don't get or don't grasp, is they're concentrating their risk in maybe one or two tickers. And then those one or two tickers, they say, well, even diversification is just going to still, when the market goes down, they all go down. It's true. But when that portfolio starts getting larger, this is where now you've got the wheel strategy that maybe is a bit different. So now you're doing something different. And in fact, what could happen is later on, when you start looking into this, this is where things get a little different, where if you've got this portfolio, you might have one group where you're doing the wheel strategy, and this is where other strategies come in. But now you've got a subset of that wheel strategy where some are bullish and some are bearish, where you've got the reverse wheel. Okay, so you've got kind of a mix. That's where you take in and do some like non-directional trading. This could be like iron condors. So if we go with more non-directional trading, that's where now these other strategies come in, like the iron condors or a calendar or a butterfly or something to that effect. So those are some of the non-directional. That's where you add in some more like speculative plays and so on. So, that's how you mix in some of those things, because the larger that account, the more you have to spread your capital and money. And that's really what makes a lot more sense, because if you go in and you start concentrating risk on a couple positions, you might say, I do my research, I do the analyst, I check this, I check that. Even then, what if one time out of the blue something happens? And what most people do is they're going in, they're building their accounts, over the course of their, let's say 0 to 50 years of their life. And then after, they hit 50 or something, then this market plummets or the strategy kind of backfires because they didn't spread enough. And that's sometimes the bigger issue and problem with what we've got going on. So anyway, my point being here is those are some tips, like learn to spread your money when it comes to a larger account, larger capital, and you got $1 million plus and you're doing covered calls or doing the wheel strategy. Eventually you'll want to spread that out to maybe the reverse wheel, where you're doing things that are opposite of your natural portfolio just to spread the risk. That's where you start getting into other strategies like iron condors, calendars, diagonals, maybe again varying those things up, adding more things into the mix. Obviously it depends on the person, depends on how motivated they are to learn those things. If you like to keep things simple and you want to just do the wheel strategy, that's fine too. Just again, learn to hedge off that tail end risk, because that can be an issue and problem for certain periods of time. But other than that, I hope that gives you a little bit of insight regarding some of those things. Now, if you're interested in the reverse wheel class, just, it's down below, or check out our website, optionsblackbelt.com. And, if you want to get access to all the classes we've got, we do a bunch pretty much every other week. We're doing a class. Just reach out, let me know, and we'll be sure to give you some more insight and hook you up with that. All right. Thanks for joining me, and I will see you next time. Take care. Bye-bye.